Wow. The start of the year has been amazing for the housing market. It's become very clear that we have a bifurcated market, but it's also very clear that mortgage applications are up. They're actually up 3 weeks in a row. Rates are down a point and a half, roughly speaking, since the peak in November, whenever that was. And we got to figure it out. Where are mortgages going? Are they a leading indicator? Yes, but what do they mean? What is going on with rates? What are some of the best, like Barry Habib calling? And to have this conversation, we're going to talk to Matt, the mortgage guy. How you doing, buddy?
I'm doing great, Mike. How you doing?
I'm doing well. So mortgage application data just comes out every Wednesday. From memory, mortgage apps were up 3% week on week. Refi demand was up 15% week on week. Both still down year on year. But the trend is clear. I think we have come off the bottom. We have 4 or 5 weeks of consistently increasing activity. And this is not a blip. This is no longer a blip. This is now a trend that we're off the bottom. Is that fair to say?
Yeah, I think so. I think, depending on who you are, some people want to see 4 straight weeks or 5 straight weeks, but third straight gain, week ending January 20, where we saw an increase in mortgage applications. It happened to coincide with rates drifting lower. So if you're a crazy like me and Mike, and you believe there's correlation between rates and demand, this would support that thesis. I'm seeing it in my personal business. I'm seeing it in multiple markets across the US. When rates come down a little bit and there's some, softness in affordability, or it's just getting a little bit better for people, they're going to take action. They're going to fill out an application to get themselves pre-approved. And like you said, it wasn't that long ago, rates hovered in the mid sevens. Now we've got low sixes that most definitely always gets bought down to a 5.25 or 5.5.
Something with a five. Yeah.
Yeah. A lot of people taking advantage of the 2-1 buy down. If you're not subscribed to Matt the Mortgage Guy on YouTube, go on there, search 2-1 buy down. I've got at least a few videos on that where, that's another tool that buyers are using to deal with what me and you don't hide from, is a little bit of an affordability issue for a lot of people. But it's getting better. And with rates coming down, and some of the folks I follow, like Barry Habib, we're going to continue to get inflation numbers. If those come down, there's a really good correlation between mortgage rates and inflation. We expect rates to follow. And if we're from 7.5 to 6, we saw an uptick in demand. Once we get to 5.75 or 5.5, then I think it truly unlocks a lot of people. One of the things I'm seeing right now, Mike, and I think this is worth people hearing, if you're a real estate agent, if you're a buyer, if you looked at your scenario in October of 2022 and you said, man, I only qualify for 420 to buy where I want to buy in the neighborhood I want to buy in, I've got to be able to get something 460 or 480. Or you looked at a payment and said, I'm not doing 3,000. I know that I can, pay 2,700 a month and not stretch myself. If one of those two scenarios is yours, look at it again, because
a point and a half makes a difference. Yeah.
Right. At 5.5 with the seller buying it down, it's going to look a lot better than, the first conversation you had where the lender said, well, if you get some credits, we can buy you down to 699. And it was too much, right? That point and a half in difference, $300, $400, $500, depending on how big of a loan you're getting. It matters. And so it's no surprise that the biggest driver for buyers is, what's my monthly payment? Rates go down and we show you a lower number for what that monthly payment is attached to a home purchase. You're incentivized to go out there and start purchasing homes. And that's what we're seeing.
Yeah. Again, consumer psychology is interesting. I've studied the consumers for 2 decades. It's where I focus on as an economist. And for much of 2022, the consumer was thinking, I missed 4% when rates were 6 or 7. Fast forward, not 9 months. The consumer is now saying, wow, I can get 5.5, not 7.5. Sign me up.
We got short memories.
Yeah, man, it's comical, but it's not a surprise. I told people this was coming and now it's here. And then again, in an environment where we have nearly record low supply, and I believe we actually have record low supply of first-time homes, because I believe So supply is 970,000 listings. The record low was, I want to be right, I think was March of last year at 880, right? So that's available listings. I believe the 970 available homes is distorted by luxury. I believe we have at least 160 to 200,000 luxury homes sitting, making that 970 look better than it should. I believe we have record low availability of first-time homes. We have rates coming down like this, and if they go lower, it's going to be a feeding frenzy. And I had an agent in the Seattle market talk about bidding wars, literally bidding wars coming back for first-time homes. But I want to go back one more time and talk about applications because they are a leading indicator and they absolutely do not mean a purchase. So an application simply in my mind means we have an interested party. An interested party is not actually, at least from an economist perspective, counted as demand because demand is two steps: interest and ability. A mortgage application does not yet mean approved. Is that true, or are all these reports, all these mortgage apps that I hear reported approved applications, and maybe I just don't know the subtleties?
No, and that's a good point. And I'll tell you, from the inside the belly of the beast, loan originator myself, we do a lot of business. I talk to a lot of mortgage brokers that do a lot of business. Exactly to your point, an application just means interest. They've got to be willing,
which is step one,
right? And
able, yeah,
right. Willing is probably filling out the application. Able
yes,
to is, do I qualify? But
exactly.
I would even argue willing might be, oh, I qualify, but I don't want a $3,400 a month payment. I don't know the old number, Mike, but through talking with dozens of high producing loan officers in today's environment, it's about 1 in 8 applications that make it to the finish line.
Wow. Okay.
And I am positive, I don't know the exact number to give you. I'm positive that that is up. It used to maybe be 1 in 5 because of the willing and able. And it makes sense if you think about it, right? Or, I'm interested, I'm willing, holy crap, I don't qualify for what I want, as much I want, at all, whatever the case may be. So this is something that gets discussed when mortgage people are trying to project, because it is a leading indicator, but you have to know that different markets behave different. We're in a market where every 5 applications meant a closed deal within 180 days. Currently in a market, it takes 8 applications to have something cross the finish line. And there's tons of dynamics, right? Depending on who you're talking to, where the applications are coming from. But in general, it's taking more applications to turn into a funded loan, which means, it doesn't all translate. But what I would say to that is, it's still going to be like, if 800 applications turned into 100 closings, if applications double, to 1,600, you're still going to have double the closings of 200. So it's still going to translate. It's just
up is good. Up is good no matter how you look at it. Again, demand has always been 2 steps. It's economics 101. It's interest and ability. And if we just have interest going up, raw numbers say that you'll have more people that have the ability, which is a good thing. Now let's talk about the big elephant in the room, because I can't believe, but there are still people calling for 8, 9, 10% mortgage rates, which I think are possible, not probable, highly unlikely, but I will say anything's possible. I also think, and I know Barry Habib is somebody that is a rock star who has won the Best Forecaster Award a couple of times, so deserves respect. I believe he's still calling for mortgage rates to be in the low 5s this year. Is that true?
Yeah, and this year, May, June, like by the end of
this
Q2,
summer.
And there's a bunch of different stuff that goes into it, but I think as we approach it, he seems to be more certain and more certain, and everybody's got their opinion. So far, we seem to be trending in a direction that would say maybe Barry's onto something.
It's a slow deflation, like air out of the balloon. Seems to be trending.
Yeah. And what we haven't talked about it in a little bit, Mike, is the Fed. I heard recently that the first 2 meetings that were like, it was guaranteed we're going to get 25-25. there might be some talks that we might only get one of those.
Yeah, I would say the last reading that I saw on the Fed is for the February 1st meeting. It was currently, and I'm going to be close, 68% of a quarter, 32% of pause. And if you rewind the clock 3 weeks, pause wasn't discussed. Now I'm going to stay by my call because why change now? I've been calling it for 6 months. We'll get a quarter. I will also stand by my call that in March we will get a quarter. But I think right now the March call is interesting because I see no way the Fed goes 75, 50, pause. This Fed wants to show a slow. So we're getting a quarter February 1st, in my opinion. I think it's an interesting discussion. Do we get a pause in the middle of March? I'm going to stand by my call and say no, but I'm not confident. I am certainly not confident. What do you think?
Yeah, I mean, I think that just the fact that the conversation has changed is something for people to look at, because this is something that people have a hard time understanding. But Fed raising the Fed funds rate a quarter in February and a quarter in March won't have an impact on mortgage interest rates, mainly because we already know it's coming.
It's expected. Yes.
Been
already priced in.
Right. Yeah. And so if you think about it, I love analogies. You know, Tesla announces they're going to have 50,000 new cars hit the line in February. If they overhit their projections, positive impact. If they underperform, negative impact. The same thing goes here, where like it's already baked in to, you know, in Tesla's thing, the stock price, in mortgage, the interest rate. And if they go 25, okay, we expected that, right? Yeah. And we say the same. If they go 25, pause, then mortgage rates likely, you know, that's a positive downward.
Yeah, that goes Barry Habib's way, right? If they do a quarter and a pause, it goes Barry's way. Rates will fall because of that. The other thing that I think really goes Barry's way is the spread, right? The spread is still abnormally high. The spread is the difference between the 10-year rate and the average mortgage rate. Historically speaking, go back 40 or 50 years, it's 1.7 to 1.8%. Today, it's over 2. If we get to the terminal rate, the peak rate, the pause, you're going to see banks compete, and that spread will come in, and it could go back to historical averages, but we also have regression to the mean. It could go below that for a little while and come back. So again, I am not calling 5%. I stand by one of my 12 calls saying we will average under 6. But dude, we get to 5%. We get people buying down to 4.5%. First-time homebuyer homes are going to be bonkers this summer.
Right. And that's the thing too, where like, I want healthy. I root for healthy. If we went to 4.75 by April, it wouldn't be a good thing, right? Because we'd have a ton of demand. There still wouldn't be
no supply. Yeah.
You know, enough supply and then it would be unhealthy. So I think the way that we're trending now, and if it continues to be kind of a slow and steady trend down, would be healthy. So I'm rooting for affordability. I'm rooting for buyers. You know, it obviously helps when I've got willing people getting pre-approved that I'm able to qualify them. But it'll be interesting to see, and for sure we're following that, because the 10-year's already at 3.8. If that spread goes down to 1.7 or 1.8, that's already low 5s. What
the
about
10-year's at 3.5, by the way, not 3.8.
No, I said 3.4.
Oh, 3.4. Okay.
3.4, somewhere in there. But with that 1.8 added to it, you know, that's 5.25. If the 10-year goes to 3 and we've got 1.8 added to that, that's 4.8. So I don't know. Eternal optimist, Mr. Matt, the mortgage guy, but you know, for a good cause, for the home buyers.
So since we're talking about the Fed, I guess your call, not to put words in your mouth, is a quarter and a pause. That's kind of what you're rooting for.
Yeah, I'm going to go quarter then pause, and I reserve the right to change my call. You like to stick with yours. I reserve the right to change with no notice.
Anytime, just change it. All right, buddy. Again, if somebody want to reach out and get something started today because they want to get a home or get an investment, how should they do that?
Go to greatmortgagebroker.com, fill out the form. We'll be in touch no matter where you're at in the country. We'd like to help you out. So go to greatmortgagebroker.com and we'll give you a ring.
Thank you, buddy. Take care.